Hey everyone, welcome back to Corporate Decoder. Today we're diving into Stitch Fix's latest quarterly report, so get ready to decode some serious style. As to maybe a few financial surprises, let's just hope it doesn't unravel at the seams. Basically, we're looking at how Stitch Fix fared up to early 2025. First things first, this is a Form 10Q, which is a quarterly report giving us a snapshot of the company's performance for the period. Think of it like a report card, but for businesses. Alright, let's jump into the financials. It's important to know that at the end of February 2025, Stitch Fix had about 112.5 million shares of Class A common stock floating around and 16.3 million shares of Class B common stock. Keep these numbers in mind as we will need them later. Time to look at the main numbers. First up, the balance sheet. It tells us what the company owns and what it owes. They had about $113 million in cash and short-term investments. It's interesting to see that they have a good amount of cash ready because in August they had about $163 million. So they burned about $563 million. So they burned about $53 million in cash. It is also interesting to see that short-term investments are growing. Their inventory, which are the clothes and accessories waiting to be sold, are around $110 million. That number is pretty important because if they can't sell those clothes, they lose money. Now let's see if Stitch Fix is making or losing money. This is on the statement of operations, and it is probably the most important financial table. Revenue, which represents how much they sold in total, was about $312 million for the quarter, which ended in February 2025. In the same period, but 1 year prior, they had $340 million in revenue. A bit of a decline. It is also interesting to see that for the 6 months ended in February 2025, they had $31 million in revenue. In comparison, for the same 6 months in the prior year, they had $695 million. Selling, general and administrative expenses came in at about $148 million for the 3 months ended February 2025. That is higher than the revenue they had of $312 million. It is important to know that they still need to pay for the clothes. They made some money with interest income due to their cash stockpile, but that was just about $2.7 million. All things considered, they ended up with a net loss of $6.6 million. If we divide this loss by the number of shares, we get a loss of 0.0005 per share. The statement of cash flow shows the movement of cash in and out of the company. Remember, this is different than profit. The cash flow statement is mostly about accounting adjustments and how cash is actually flowing. The company used $129 million in operating activities during the last 6 months. It is interesting to see that they had $160 raised $100 in dollars and $3 million in cash at the bank account over this period. They also spent a bunch on investments and other things too, such as property and equipment. Finally, the cash used in financing was around $8 million due to payments for tax withholdings. Alright, let's see what's new in the accounting world. The company provides some information about new accounting guidance, which can be a huge deal because sometimes it changes how companies are required to report their financial situations. It looks like they are mostly waiting on how things will shake out. The first one is about segment reporting, that is how companies show the different parts of their business. The second accounting pronouncements is about income taxes to make those disclosures more transparent. Finally, the last update, which they are currently evaluating, pertains to making it more clear where expenses in the company come from. Jargon alert. Fair value is basically what something is worth in the market, and this section talks about how the company figures that out for its assets, like investments. They had $52.8 million in money market funds, which are like super safe savings accounts, and a lot more in corporate bonds. Here's something to keep an eye on. Some of their investments have what are called unrealized losses, but not a big deal because it is only a bit. Think of unrealized losses as investments that are currently worth less than what they paid for them, but they have not sold them yet. They were holding on to hope for a recovery. Next up are the legal headaches. So it looks like the class action lawsuit regarding false and misleading statements is still ongoing. This section talks about how Stitch Fix pays its employees with stock. It is important to see that some employees get stock options and others get restricted stock units, RSUs, which are basically promises of stock in the future. Here we're dealing with the financial aftermath of their UK business closure. This discontinued operation was a decision to pull out of that market, and there are still some financial loose ends to tie up. Alright, now let's get to the management's take on all this. Management acknowledge a decline in revenue and challenges in getting new clients and retaining old ones. These challenges have been weighing down revenue, and they think this is going to continue. Management seems to be on the same page when it comes to being as efficient with capital. To grow revenue again, management needs to focus on retaining current customers and getting new ones to actually make a purchase. They have to be able to predict what people want to wear. It is a tough job to keep up with trends. Finally, the executive seems confident in the accuracy of their numbers, meaning they think their financial reporting is solid and reliable. Looking at the recent sales of Class A shares, this might signal that they are anticipating good things in the future for Stitch Fix. However, since they have so much voting power that it will not make a difference, the risk of further lawsuits, the risk of being unable to anticipate what to buy for their customers. So what's the real story here? Stitch Fix is trying to navigate a tricky situation. Declining revenue is bad, but they are aware of what has to be done. They know that they have to be profitable somehow, or at least cut expenses. I like that expenses are down and the management recognizes that. The interesting thing is that active client numbers are down, but each active client is spending more. While being more efficient is good, there are some inherent problems to the business model of Stitch Fix. For example, how does Stitch Fix differentiate itself from other companies? The space is becoming very crowded, and that is the main challenge. Thanks for tuning in to Corporate Decoder. If you found this helpful, give us a like, leave a comment and subscribe for more dissections of the corporate world.